Hello everyone. Now let's continue our discussion about Chapter 1, which is about Introduction to Accounting and Business. And now the focus is on principles. So there are four principles that we need to learn in accounting. The first one is called measurement. The second one is historical cost. Then we have revenue recognition and expense recognition. Measurement principle determines the amount that will be recorded and reported. Transactions between two independent parties called arm's length transaction provide amounts that are objective and verifiable. And that's what we mean by measurement. Like anything that we need to record in the accounting reports should be measurable. So in other words, we can verify its value in an objective way. The other principle is historical cost. It says here, recording an item at its initial transaction price is called the historical cost principle or cost principle. In other words, we have to record every transaction based on how much we actually paid or received. So it has to be based on the history. We cannot adjust it to what we call it the current value or what we feel like it should be. So let's say we bought a computer that was originally for a value of $500. We bought it only for $300. We have to record it in the records as $300 computer. We cannot record it as 500 because we feel we got a good deal and the original value was 500. It doesn't work that way. So in accounting, we have to record the historical cost. The interesting thing that we have to also keep the cost based on what we paid. So let's say the value appreciated over time. We still have to keep the $300. The other principle is revenue recognition principle. And revenue is the amount earned or received from providing services or selling goods to customers. So any kind of, we call it amount earned or amount received, or I would like to call it the income received from customers, from selling a good or a service. In this case, we call it a revenue. The revenue recognition principle determines when revenue should be recorded in the accounting records. And basically, in this principle, we have to record the revenue when we actually make the sale or when we actually provide the service. Expenses, on the other side, these are amounts used to generate revenue. In other words, these are the expenses or the costs we incur. Based on that, we have the expense recognition principle, sometimes called the matching principle. Requires expenses to be recorded in the same period as the related revenue. So we have to match the revenues and expenses of the same period at the same period. Now let's talk about one important thing in accounting, which is called the accounting equation. That's something that every accountant should learn by heart, which is assets equal liabilities plus equity. We call it the accounting equation. Assets are the things we own. Liabilities are the things we owe. And equity is our right in the things we own. And I'll try to explain that in more details. So, business transactions and the accounting equation, I think this is something that will give us an idea of the accounting equation, how it works, and we will just use some examples to clarify the concept here. So, an economic event or condition that directly changes an entity's financial condition or its results of operations is a business transaction. And you may have heard me saying transactions several times before. And again, a transaction is any exchange between two parties. That's how we can consider it a transaction. So I would like to give examples about buying a product, selling a product, paying cash, collecting cash. Each one of these is an example of transactions. So all business transactions can be stated in terms of changes in the elements of the accounting equation. And that's the key thing about transactions, is that they impact our assets or liabilities or our equity. So let's see transaction A here, and it gives us some kind of idea of a starting point for many businesses. So on November 1st of year 3, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares of common stock in the corporation. So the thing I want you to remember here, Chris Clark is the owner, but remember the business has a separate entity, or it has its own identity. So in this case, the $25,000 invested by Chris Clark is now owned by the business, or it's actually held by the business. And Chris Clark is becoming an owner in the business who has equity in that kind of business. So a corporation issues common stock to investors as proof of their ownership rights. This transaction increases cash. Why? Because you can see that Chris Clark brought cash to the business. So their assets, where they have cash as one of those assets, is increasing on the left side here, as you can see. So let's say here, this transaction increases cash under assets on the left side of the equation by $25,000. To balance the equation, we have common stock under stockholders' equity. That's the right-hand side of the equation would increase with the same amount, which is $25,000. One thing I want you to remember is that the accounting equation has to be always balanced. So once we increased something on the left side of the equation, something also has to increase on the right-hand side. So it has to be always balanced. And now you see assets, which are our, like in this case, it's our cash. It increased by $25,000. Same thing happened to common stock. It also increased by $25,000. So the effect of this transaction on Net Solutions accounting equation is that, again, we have the same assets and equity with the same amount. Liabilities are not there because the business does not owe anyone or anything yet. So we should have liabilities, but it's going to be zero in this case. So let's see transaction B. On November 5th, year 3, Net Solutions paid $20,000 for the purchase of land as a future building site. The purchase of the land changes the makeup of the assets, but it does not change the total assets. So now let's see what happened. They used part of the cash that Chris Clark brought to the business, and they bought a land. So what happened to cash? As you can see here, cash went down by $20,000, taking the balance down to $5,000. How about land? Now we have a new asset called land. So cash and land, these are assets, things we own. So the land went up by $20,000, which is the value of what we paid. So if you look at the total balance for assets, it's still $25,000, but instead of all cash, now we have only $5,000 for cash and $20,000 for land, making the total $25,000. The equity is still the same, did not change, and we don't have any new liabilities or anything. So the left-hand side of the equation is still equal to the right-hand side of the equation. Let's see transaction C. It says here on November 10th, year 3, Net Solutions purchased supplies for $1,350 or $1,350 and agreed to pay the supplier in the near future. So they didn't pay yet. Okay, they promised that they're going to pay in the near future. This type of transaction is called a purchase on account. So remember, that's purchasing on account. And the account that's usually related when we buy on anything on account is account payable. So there's a specific account called account payable. So the supplies purchased, they had a value of $1,350. Supplies is considered to be an asset. When we owe someone or when we promise someone that we're going to pay them in the near future, we're creating the account payable, and that's a liability account. So the liability created by purchase on account is called account payable. So items such as supplies that would be used in the business in the future are called prepaid expenses, which are assets, and we'll get to that later on. So now let's see the impact on the accounting equation. Now we have three assets. We have cash, we had the land from before, and now we have supplies. Cash and land, they're staying with the same value, $5,000 and $20,000. Nothing changed here. However, we got a new asset, which is supplies, which cost us $1,350. On the right-hand side, our equity is still the same, $25,000, but we owe the company that we bought from these supplies $1,350 under the account called accounts payable. So if we add all the assets, $26,350, which is the left-hand side of the equation, it's equal to the right-hand side of the equation, which is $26,350, consisting of equity of $25,000 and $1,350 for the account payable. I hope this is clear. Every single transaction should always keep the accounting equation balanced. We cannot really have something that's not balanced. If they're not balanced, then there's something wrong. So there's something that's not recorded. Let's see transaction D. On November 18th, year 3, Net Solutions received cash of $7,500 for providing services to customers. Let's try to think about this. When you receive cash, is cash going up or down? It's actually going up. So the amount of cash that used to be $5,000, now it's more. It's increasing by $7,500. So it's $12,500. The receipt of cash increased Net Solutions assets and also increased stockholders' equity in the business. How the stockholders' equity is increased? Because we earned some resources, which we call it fees earned, based on the service that we provided. And these fees earned, that's a new account now. It's a new account and it's going to increase by the amount of our revenue, $7,500. Fees earned is a revenue account, which increases our equity. And by the way, it's good to remember, revenues increase stockholders' equity, expenses decrease stockholders' equity. So the revenue of $7,500 are recorded in a fees earned column to the right of common stock. The effect of this transaction is to increase cash and fees earned by $7,500. So you can see that cash went up to $12,500, supplies are the same, land is the same. Now our total asset increased slightly by $7,500 to reach a value of $33,850. On the right hand side of the equation, liabilities are the same, common stock are the same, fees increased by $7,500. But again, the total for liabilities and stockholders' equity is $33,850. So, as we've seen, revenues from providing services is recorded as fees earned. And I want to remember that. When we provide service, we call it fees earned. Revenues from the sale of merchandise, later on we're going to see, we call it sales. So when we provide a service, we call it fees earned. Some textbooks, they call it service revenue, but in this textbook, they use the term fees earned. And whenever we sell a product, when we sell a merchandise, we call it sales, or sometimes we call it sales revenue. Other examples of revenue include rent, which is recorded as rent revenue, or it could be interest, which we recorded as interest revenue. And remember, all these kind of revenues, they would increase your equity. So instead of receiving cash at the time services are provided or goods are sold, a business may accept payment at a later date. In this case, we still record the revenue or the fees earned, and we are, instead of having cash increase, we are going to use accounts receivable, which is similar to accounts payable. So as it says here, such revenues are described as fees earned on account or sales on account. So in such cases, the firm has an asset called accounts receivable. Let's see the next transaction, transaction E. So on November 30th, year 3, Net Solutions paid the following expenses during the month. They paid wages, they paid rent, they paid utilities, and they paid some miscellaneous expenses. And by the way, all of these are expenses. So we should expect that these expenses would reduce the company's equity. So during the month, Net Solutions spent cash or used up other assets in earnings revenue. Assets used in this process of earning revenue are called expenses. So expenses include supplies used and payments for employee wages, utilities, and other services. So let's see how this would impact the accounting equation. The effect of the expenses is the opposite of revenue in the expense reduced assets and stockholders' equity. Like fees earned, the expenses are recorded in the columns to the right of the common stock. So remember, we had the common stock where we have the investment by Chris Clark, the owner of the business. When the business provided services, they had fees earned. Now we have minus signs here because these are going to reduce the stockholder equity for wages expense, rent expense, utilities expense, and miscellaneous expense. So we record each one of these separate. We put expenses separately, each one in its own category. So we can know which one is impacting, like what did we spend this money on. So on the other side, the total of these four values ended up to be $36.50. This is the amount that was paid in cash, so it brought down the cash balance from $12,500 to $88.50. So we deduct 3650 from the 12,500 to get a new balance, which is 8,850. Now the total assets is 30,200, and the total stockholders' equity would be the same, 30,200. Don't forget, you have to subtract the expenses from the stockholders' equity balance. That's how you can get the total value of liabilities and stockholders' equity. Now let's see transaction F. On November 30th, Net Solutions paid creditors on account $950. They paid creditors, people who we bought supplies from in the past. Okay, now we are going to pay them. So we don't owe them this amount anymore. But remember, we bought the supplies for $1,350. We didn't pay the whole balance. We only paid $950, so that left $400. So, and remember also that was paid using cash. So cash should go down by $950. So now it went down from $8,850 to $7,900. And accounts payable, remember we had $1,350 based on the supplies that we bought on credit. Now we paid part of it, so it went down by $950, and now the new balance is $400. If we add all our assets, all our liabilities and stockholders' equity, the two sides of the equation should be always equal. So the paying of an expense reduces stockholders' equity, as we've seen in transaction E. Paying an amount on account reduces the amount owed on a liability. Now let's see transaction G. On November 30th, year 3, Chris Clark, who's the owner of this business, or the investor in the business, determined that the cost of supplies on hand at the end of the month was $550. So try to remember, how much did the business buy worth of supplies? It was $1,350. Now the leftover is $550. How much worth of supplies did we use during the period, or during that month? It's the difference between what we started with, which is the $1,350, and what we ended up with, which is the $550, and that would be $800. So the cost of supplies on hand not yet used at the end of the month is $550. That's the leftover. I like to call it the leftover. So we have to see how much we have at the very beginning, deduct from it the leftovers to see how much we actually used worth of supplies. So when supplies are used, we create an account called supplies expense, and it's going to be recorded under equity, and it is going to reduce the company's equity. So as you can see here, now we have a new account that has supplies expense. It's called supplies expense, and it has $800, and we reduced our supplies balance by $800 to get the balance, the new balance of $550. Now let's see the next or last transaction for this example, which was transaction H. November 30th, year 3, paid dividends of $2,000. What are dividends? Dividends are what the company would pay to its shareholders as a way of distributing their income. So dividends are distributions of earnings to stockholders. The payment of dividends decreases cash and also reduces stockholders' equity. So remember, when we pay dividends, cash is going down, and the company's equity, or the equity of the owner, would go down. So like expenses, dividends are recorded in a separate column to the right column stock as a negative amount. So let's see that. We have accounts payable, which is the only liability we have for this business, and then we have common stock, which is our equity, minus dividends, which is something that reduces the common stock, or it reduces the equity. And then we have the fees earned, which is a revenue, which increases your equity, and all the expenses, they also reduce equity. So dividends and expenses, they work similarly because they reduce the stockholders' equity. So in this case, the company paid $2,000 in cash, reduced the cash balance from $7,900 to $5,900 because of the $2,000 distribution of dividends. And dividends is going to be recorded as $2,000, but with a minus because it has a negative impact on equity. So if we summarize this whole idea, you can see that we have assets equal liabilities plus stockholders' equity. That's our main account equation. Under assets, we had cash, supplies, and land. And under liabilities, we only had accounts payable. And under stockholders' equity, we had common stock. And we had all these other things that would impact the common stock. So we started in transaction A, and then transaction B, we got the balance. Transaction C, we got the balance. And that's like a worksheet that would show you like how the balances are working. The important thing about this worksheet, and I think in the homework you should try something like that, the balance on the asset side should equal the balance on the liabilities and stockholders' equity. So the accounting equation should always be balanced. That's a key thing based on the accounting equation. One other thing here, I want you to see the impact on stockholders' equity. So when we issue new common stock, that increases stockholders' equity, like stockholders' investment. Remember when Chris Clark brought $25,000 to the business, that increased the stockholders' equity. Distributions of earnings to stockholders reduces the stockholders' equity. So the distribution would reduce the stockholders' equity. So the dividends are examples of distributions. And remember, that reduced the stockholders' equity. Revenues, these are increases to the stockholders' equity. Expenses are accounts that would reduce the stockholders' equity. The difference between revenues and expenses, we call it the net income or loss. If revenues are more than expenses, then we have net income. If revenues less than expenses, we have something called net loss. So all businesses, they wish to have more revenues than expenses to be able to survive. So the combination of dividends and net income, when we put them together, that's what we call it retained earnings. So net income would increase retained earnings. Dividends are one of those things that would reduce retained earnings. So stockholders' equity, to summarize, stockholders' equity consists of two things. Common stock, which is the contribution of the shareholders, and then retained earnings, which are the net income that was kept in the business after making all the distributions. So both of these put together, we call them the stockholders' equity. So the two main components of stockholders' equity is common stock and retained earnings. Remember, common stock is what the investors would bring to the business. The retained earnings is the amount of net income minus the dividends or the distributions. And remember, net income is the difference between revenues and expenses. So as I say here, retained earnings is the stockholders' equity created from business operations through revenues and expense transactions. So let me stop here. In the next video, we're going to go over our final product, which is the financial statements.